Hi, everybody, and welcome to Chapter 15. And here we're going to be discussing dilutive securities and earnings per share. Our learning objectives, we should be able to describe how we issue, convert, and retire convertible securities, contrast the accounting for stock warrants with stock rights, describe the accounting and reporting for stock compensation plans, compute basic earnings per share, as well as compute diluted earnings per share. So if we preview Chapter 15, our dilutive securities are going to include convertible debt and convertible preferred stock. Then we'll move into stock warrants. We'll look at stock warrants and some other securities, as well as stock rights. And if we look at stock compensation plans, we have several. We have stock options, we have restricted stock plans, we have employee stock purchase plans, trends, and disclosure of compensation plans. Our basic earnings per share, we're going to take a look at a simple structure. And then if we move into dilutive earnings per share, we have convertible securities, options and warrants, contingent issues, anti-dilution, and those will dilute our basic earnings per share. And then we will show how we present and disclose that, as well as a summary. All right, we'll get into the meat of the chapter here. We're going to describe accounting for the issuance, conversion, and retirement of convertible securities. So if we look at this little illustration here we have a company with 100,000 common shares outstanding. And we have three stockholders that own 35%, 40%, and 25% of that 100,000 shares. But now the company issues 10,000 new common shares. So now we have 110,000 shares. Our original stockholders own the same amount of shares, but their percentage ownership has been diluted by the additional 10,000 shares. I think that's pretty easy to see how we can dilute ownership. Okay, how do we account for convertible debt? Convertible debt are bonds or notes that have the added feature of being able to convert into common stock during a specified period. So why would some companies recently issue bonds as this method of financing? Well, to lower interest costs. Generally, convertible debt offers a low interest rate to investors because investors place a value on that conversion feature. And then also to manage the corporate structure. Issuers often have a call feature attached to convertible debt. This feature enables the issuer to have some control over its capital structure. But why would an investor be interested in convertible debt? Well, equity gain. In a rising stock market, convertible investors may participate in capital appreciation. And two, principal and interest protection. Convertibles provide protection when the stock market is declining, because the convertible can provide interest income and principal recovery. So at the time of issue, we're going to look at recording convertible bonds. And that follows the method used to record straight debt issues with any discount or premium amortized over the term of the debt. So looking at a global view briefly here, IRS requires that the issuer of convertible debt record the liability and equity components separately. So we have the value of the debt component, the value of the equity component, and the value of the convertible bond. Now, the companies use the book value method when converting bonds. When the debt holder converts the debt to equity, the issuing company recognizes no gain or loss on the conversion. Let's take a look at an illustration. The Lindor Company issues 50 convertible bonds with a 5-year life with a par value of $1,000 each to Hernandez Incorporated. The bonds sold at 102, so we know that it sold at a premium. Each bond is convertible into 40 shares of Lindor's $1 par value common stock. The fair value of Lindor's equity component at the date of issuance is $200 for each bond. What entry would Lindor make to record the issuance of the convertible debt? Well, to record the issuance of that debt, we're going to debit cash, and here we have $1,000 bond increased by the 102% times the 50 bonds. That's $51,000 debit. We're going to credit bonds payable for what's written on the bond, $1,000, 50 of them, $50,000. So that means our premium is going to be $1,000. Lindor is going to ignore any value related to the equity feature at the date of issuance. Therefore, Lindor does not record the fair value of its equity component. Because Lindor records the convertible bond as a straight debt issue, the premium on the convertible debt will be amortized and reduces interest expense over the 5-year life of this bond. So pretty straightforward there. Now, if we look at the same information from the prior slide, Hernandez, the purchaser, decides to convert its 50 convertible bonds into common stock at the end of the second year. At that time, the remaining premium on the convertible bonds is $580. In addition, at the time of conversion, the fair value of Lindor's common stock is now $1,300 per share. So, how should Lindor record the conversion? Well, we're going to debit bonds payable. That's what we have on our balance sheet currently. We're going to zero that out with the debit to bonds payable. The premium that was left, we're going to zero that out at $580. And then our common stock, we're going to take 50 of them. We're going to multiply that times 40, and they're $1 par value. So that gives me $2,000. And that excess is going to go to paid in capital in excess of par, common stock for $48,580. Sometimes an issuer might want to induce a conversion. The issuer wishes to encourage prompt conversion by doing that action. The issuer offers additional consideration, sometimes called a sweetener, and the sweetener is an expense of the current period. So let's look at an example. Grays Incorporated has outstanding $1 million par value convertible bonds, convertible into 100,000 shares of $1 par value common stock. Grays wishes to reduce its annual interest cost. To do so, it agrees to pay the holders of its convertible bonds an additional $80,000 if they will convert. So assuming the conversion occurs, how should Grays record this transaction? Well, we're going to debit the conversion expense, as we explained in the prior slide, to recognize this sweetener, and then we're going to wash out bonds payable for $1 million. We're going to convert that into common stock by debiting common stock at par here, 100,000 shares at $1 par, and then the remainder is going to go into paid in capital in excess of par for 900,000. And the cash we're going to spend is going to be $80,000 to pay off the sweetener. So you can see that Grays is going to record that additional $80,000 as an expense in the current period and not as a reduction of equity. The expense is reported in other gains and losses section of the income statement. Okay, if the debt is extinguished, a lovely academic term, or paid off before its maturity date, the company records a gain or loss from the difference between the reacquisition price of the debt and its carrying value. Pretty straightforward there, I think. The gain or loss is reported in the income statement as other gains or losses. Okay, so convertible preferred stock includes an option for the holder to convert preferred shares into a fixed number of common shares. So these convertible preferred stock is part of stockholders' equity, not liabilities, unless a mandatory redemption exists. Okay, so remember, convertible bonds are liabilities. So be careful. Do not confuse convertible preferred stock with convertible bonds. Okay, so let's take a look at an illustration. Here, Middleton Enterprises issues 1,000 shares of common stock, par value $2, upon conversion of 1,000 shares of preferred stock at a par value of $1 that was originally issued at $4 per share. The current market value of the common stock is $5 per share. So how is Middleton going to record this transaction? We're going to debit and reduce convertible preferred stock first at its par value of $1,000 and second as it's paid in capital in excess of par for $3,000. The credit is going to be $2 par value on the common stock, which is $2,000, and the difference being paid in capital in excess of par common stock for $2,000. Okay, we'll move on to the next learning objective, and here we're going to contrast the accounting for stock warrants with stock rights. Stock warrants are a security that gives investors the option to purchase a company's stock at a specific price over a specific period. Warrants are typically included as a sweetener to investors to purchase a company's bond issuance. So the investors like warrants because they provide an opportunity to share in the future growth of the company or to sell warrants in the market. And they do sell in the market. Companies use stock warrants to reduce the cost of financing, that is, to pay lower interest rate. That looks like a good place to end this first video. And when we return, we'll take a look at stock warrants issued with other securities. Until that time, bye for now.